Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartsandmarkets.com runs down the major markets. He says the seasonal trade in gasoline is starting to kick in. He checks out crude, gold, the U.S. and Canadian dollars. InsideTrackTrading.com President Eric Hadik examines the cycles that could have some influence on your trades. Even war apparently has a natural cycle. Publisher of TheTrendletter.com, Martin Straith, tells us what might be holding up your investment success and how to overcome it. Plus, at the end of the show, we'll have a company showcase update from RecycLiCo CEO Zarko Meseldzija. We'll talk to Ross Clark right after this.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to This Week in Money.
Always a pleasure, Jim.
Ross, how would you describe what happened on the stock markets this week?
Well, let's see. If you get 3 or 4 bad days in a row, you're going to get a good day after that. And if you get a series of good ones, you're going to get a bad one. So we got the month of January has now become so choppy that it doesn't matter whether you're looking at the Dow, the NASDAQ, or the S&P. It's an inside trading month. We are below the December highs, and we're above the December lows, and the market just does not have any dominant direction in here. There's a few sectors that have got some life, in particular over in the mining sector. Things are doing quite well over there. And, we take a look at the overall market sentiment numbers here. Take a look at the put-call ratio. We're down to levels that are typically more bullish than bearish because we've got too many bears out there. Look at the American Association of Investment Advisors. The bear sentiment there is at about 42%. And anything over 40% is fairly high. The bulls are down in a 30-year low, 26% bulls. So you got a lot of very cautious people out here. And, we're in that seasonal favorable period, end of October through the end of April. And, the odds are still that markets are going to try and punch their way through this initial resistance. Who knows how far they will go. But at this point, the probably end up with the January lows. We've only got a week or so to go on that, but keep an eye on it. But the January lows, if they hold in, we probably get a decent pop in through February and March.
What's happening with the yield curves?
Yield curve, this has been one that Bob and I have been keeping a pretty close eye on. Continues to, we take a look at the 2s versus the 10s, and it continues to be very stable in here. It's got some, the difference in the rates is at about 70 basis points right now, and just a little bit tired. If it starts to break down through 50, then we're going to consider that to be a sell signal. But as of now, trend is still favorable for the market, but it's one of those items that we want to have just sitting out on the horizon that we keep an eye on.
What's happening with crude?
Crude has some life over there this week. Not a breakout, but enough to cause a little bit of excitement. We ended up at just over 81.5, and if we take a look at the oil stocks, the gassy stocks, pretty darn good week. And you take a look at some of the big names, the Exxons, the Chevrons, and they are up once again, flirting with all-time highs. I mean, here's Exxon at 113, and this is above the highs that we saw back in 2008, the highs that we saw in 2015, doing exceptionally well over there. And on the broad industry, like the ETF, it's up within a hair of that high. And on the Canadian side, the XBG been doing not too badly, sort of the top third of its trading range for the year. So there's some buoyancy in there. The oil market itself, I think, you pretty much got to get through 82 to see that it's breaking out at all. The within the complex, though, the seasonal play here we've mentioned is the gasoline. And so if you take a look at the UGA, which is the ETF there, that's got that nice double bottom between the summer low and the October-November low down at 50 on the index. It's at 63 3/4 and just starting to break out quite nicely. There's a very dominant seasonal pattern here, so this continues to be a pretty good-looking trade. I think you can buy minor corrections in there, but this should end up with pretty good legs in it. And from a seasonal perspective, as I say, as the various refiners go through their changeover process here, there's going to be a shortage of product, and prices are bound to work their way higher. Now, some of that will already be priced into the futures markets, but it will still be a decent play, I think, for the upside.
What's going on with gold?
Gold had a reasonably good week. It's from my measurements, it went into a first sort of level of overbought back here a couple of weeks ago. I have various degrees that I look at in terms of what I call exhaustion and capitulations. And we're at that initial stage as far as gold is concerned. The miners aren't that strong. The miners have been very steady and grinding their way higher. But the gold itself had that really nice move just in this last month from 1,800 up to 1,928. So first levels of overbought are there. If we have a correction at this point, you're probably looking at a $40 or $50 pullback that would be reasonable. If things accelerate to the upside, and seasonally we would expect that it'll be more into mid to late February that you'll be looking for the high. If they accelerate towards that, probably end up with a much deeper correction. But for now, say anything in the $40 to $50 bracket for a pullback, I would look at as a very reasonable buying opportunity.
What about the U.S. and Canadian dollars?
We didn't. And, I've been looking at the Canadian. It's stuck in the trading range, not doing a lot here. And, you take a look around for what the outside effects might be. And so, from an agricultural commodity perspective, there's nothing really that's helpful there. The ag commodities have been under some pressure, and they're not going anywhere. The crude oil has been supportive to it. But if we look at the interest rate side of things, the difference in the rates between Canada and U.S., not enough to attract any big capital. So, we're stuck in this trading range. We got a really good oversold reading back in October down at 72 cents. That decent bounce to 75.5. But, it's a trading range. And, I wouldn't try and make too much out of it at this point. That overhead, that 75 is going to be, I think, fairly difficult to get through.
Ross, thank you so much for the update.
Good to be with you, John.
My guest has been Ross Clark from ChartsandMarkets.com. Find him on Twitter at ChartsByRoss. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Hadik, CEO and President of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to the show, Eric, and I hope you haven't been washed away.
Well, thanks for having me back, Jim. I'm still here and starting to dry out. And fortunately, in our immediate area, we haven't had much damage other than just your typical over rain and a little bit of washout.
Eric, how are things at Inside Track, and how can people sign up?
Things are going pretty well. I can't complain. And anyone that's interested in finding out any information or subscribing can do so at InsideTrackTrading.com. That's inside with the extra I in the middle, so it's INSIIDE TrackTrading.com.
Back in 2021, you described a scenario in which you thought 2022-23 would resemble 1973-74 in many ways, including a prolonged bear market in stocks and, for me, the return to tie-dye shirts and bell-bottom pants. Now, where does your prediction stand on that prolonged bear market?
Yeah, I was going to say, I'm not sure about the tie-dye shirts and that, but as far as the stock market, and let me give a little history or context to that analysis. When I was describing that in throughout 2021, I was also referencing a very longer term and very consistent natural cycle, a 49-year cycle that is combination of seven-year cycles. Those are cycles that you can even go back to the Old Testament and the Bible, and you will find them laid out for agricultural practices for the Israelites. And that 7-year cycle has carried forward even in modern-day organic farming principles. And so it's a very consistent cycle. And the 49-year cycle is kind of a higher multitude cycle that I've seen impact the market. And there was a lot of other things coming together. I always base my work on synergy, so it's not just this one particular cycle. But there was a lot of things coming together that were really kind of raising my antenna and radar and sensing that 2022, 2023 could resemble that 73-74 period from 49 years earlier in many respects, geopolitical, social, and you've seen many of them play out. But as far as the stock market, in 1973, in January of 73, stock market top. In January of 2022, stock market top. In 1973, stock market sold off into the third quarter of the year. In 2022, stock market sold off into the third quarter of the year. And then there was some consolidation. And so that parallel is still playing out in many respects. And I don't expect it to be in lockstep with, every month that a turning point occurred 49 years ago, it should now. I'm speaking from a general perspective, but then there were and still are enough current indicators, timing indicators, cycles that give me more specifics and reinforce that idea that an overall bear market is unfolding, that I keep marveling at the similarities to 1973-74. For right now, I think that the stock market is still in a consolidation phase after setting the lows in late September last year, with some stocks retesting those lows in November. And I'm looking for the next multi-month high to take hold most likely in March of this year. between now and then, there's a couple of intermediate cycles that I think will time some of the swings within this evolving rebound. But depending on where a lot of the indexes and individual stocks have reached in March of this year, that will influence what I expect moving forward from there.
What do stock market cycles project into 2024 and beyond?
There's actually a lot of intriguing potential for the next 2 to 3 years. And from the longer term cycles that I watch, I think you could be looking at some 6 to 12 month swings that create 1 to 2 year highs and 1 to 2 year lows, so more of a volatile, perhaps sideways trading as opposed to a convincing trending market. I talked about not only that 49-year cycle, but there was a host of other cycles coming into play in early 2022, cycles that were as big as 10, 20, and 40-year cycles, and cycles that were more intermediate, like 4-month, 8-month, 16-month cycles, all of them projecting a significant top in early January 2022. But moving forward from there, a lot of contrasting but also corresponding cycles were telling me to look for a low in 2023. There's a very consistent 7-year cycle that has timed the low of stock market sell-offs / crashes over the last several decades. More recently, you can look at the lows that were set in early 2002, then 2009, then 2016, each of them after significant sell-offs. And 2023 perpetuates that pattern, and that pattern even ties back to lows that were seen in late 1987, lows that were seen in 74. It's a very consistent 7-year cycle and overlapping 14-year cycle and even a 21-year cycle, all of which are arguing for a bottom in 2023. But there are just as many competing cycles coming into play in 2024, telling me to look for at least a 1 to 2 year top then. So that's why I say you could see this. You've got your peak in early 2022, expecting a bottom in 2023, but then a contrasting top in 2024, and a lot of this more whipsawing shorter trends, 6 to 12 month trends or 3 to 6 month trends, as opposed to multi-year trends that the traders have become accustomed to.
The U.S. dollar has dropped below its 50-week moving average, yet it's still above its 200-week moving average. Are you still looking for a major dollar peak in 2023?
Yes. Nothing I've seen has changed that outlook. Not only was that outlook linked to, and I know I've described this in our discussions many times before, but a very consistent 3.25-year cycle in the dollar that has timed the intervals between a lot of major lows and highs. And that particular cycle was what had me looking for a multi-year low in the beginning of 2021 and a subsequent rally into the first half of 2023. But there's also the longer-term wave structure and trend and cycles in the dollar, going back to its low in 2008 and the uptrend that has unfolded since then. All of that is from both price and timing perspective, showing that we're coming into the time when a culmination of that 14 to 15-year uptrend in the dollar index, and when these various cycles are coming into play. And there's certainly some key fundamentals that I think are slowly, steadily developing. They just have not really taken hold yet. And one of those was reinforced in December last month, when you had this big meeting between China, when Xi Jinping met with Saudi Arabia and the Gulf Cooperation Council, the joint unification of all of those Persian Gulf oil-producing nations. And China was committing to buy a great deal of Middle East oil, and there was just one additional caveat, condition, whatever the case may be, to that oil purchase, was that China was planning on ultimately paying for all that oil in Chinese yuan, which would be certainly a reasonable assumption from their perspective. But one of the things that has supported the dollar for 50 years has been the de facto agreement reached back in that same 73, 74 time frame, when OPEC started pricing oil in dollars, and has ever since. And there have been moves and intentions and announcements of different nations pushing to start pricing oil differently, whether that be in euro, whether that be in Middle Eastern currency. But now when you have as big a player as China coming to the table and saying, okay, the U.S. doesn't get as much of their oil from the Middle East anymore anyway, and here China is also implementing or starting their own petroleum exchange. That shift is something that when it takes place, I don't even think it's an if anymore, but when it takes place, that will reverberate through the Forex markets, and may not be all at once, maybe a slow, steady thing at first, but it's one of those types of fundamentals that after it starts to unfold and you see the ramifications in the dollar and everything else, then everyone says, oh, where did this come from? We could have never imagined this happening. When the tea leaves have been there all along, and a slow, steady progression of events and of announcements have made it clear what the objective was, but no one wants to really acknowledge them or give them any credibility. And I think that in the coming years, that's going to be one of multiple fundamentals that create some real headwinds for the U.S. dollar. I even think on an intermediate basis that you've got the culmination of the interest rate hike cycle in the U.S. That's also one of those things from a kind of buy the expectation, sell the realization, or buy the rumor, sell the fact, as the old adage says, that's also structured or set up to time a significant peak in the dollar this year as interest rates hit a peak, and that's been something supporting the dollar for the last year and a half. So what's going to be left to continue to prop it up when it becomes clear that interest rates have peaked, and then maybe you see things towards the end of next year, towards the end of this year or into 2024, that start to get discussions about, maybe interest rates need to be pulled back a little bit. Well, the dollar will have its reaction to that as well.
How does that impact gold cycles, and where are precious metals in their overall cycles?
Well, as I frequently warn my readers and listeners in discussions like this, the dollar and gold do not trade on a precise 180-degree inverted correlation as many traders seem to think they do or they should. It's often that just general assumption that, if we're talking about gold priced in dollars, then if the dollar goes down, gold goes up. If the dollar goes up, gold goes down. And that's often not the equation. And I won't even get into that. I explain a lot of the nuance of that in several of my publications and reports. But the bottom line is that gold is in a bullish cycle that it entered in fourth quarter of last year. Although from my work, that's just looking right now at least at a 6 to 12 month bullish cycle that could ultimately stretch into September, October of this year. But from a broader perspective, gold's really in a big wide trading range that when it peaked in late 2020 and then retested that peak in early 2022, it was setting the upper extreme for that trading range. And when it initially sold off into March of 2021, and then when it most recently sold off into November of last year, it set the bottom for that trading range, and both of those lows and both of those highs were in close proximity to each other. It's what's sometimes referred to as a flat correction. But I think that gold is destined to stay in that range for quite some time, although I think there will be some pretty significant moves and trends in both directions and some really good trading opportunities. But as long as traders are nimble and are not getting married to positions in gold.
Is the interest rate cycle still projecting higher rates ahead?
The cycles that I watch in interest rates are certainly allowing for a little bit more bump up in interest rates, but there's been a very consistent 4-year cycle in bonds and notes that timed with great precision the peak in July 2020, which was when corresponding interest rates bottomed, and it also it timed the October 2022 lows in bonds and notes. And even though short-term interest rates have continued to rise since then, bonds and notes representative of 10-year and 30-year interest rates have those markets have rallied, which is indicative of the underlying rates dropping, not rising. So you're starting to see that that disparity or that divergence within the yield curve. And so bonds and notes have been saying that a bottom is intact or a peak in the corresponding interest rate, even as shorter term interest rates still have the potential for a little bit more bump up. But what I've been looking at is more out into mid-2024, the next phase of that 4-year cycle, when bonds and notes should set their next 1 to 2 year or longer peak, which would mean that the corresponding longer term interest rates would be bottoming at that time. So probably some consolidation right now, some back and forth trading leading into and out of Fed meetings and other related reports, releases. But all in all, we're near the peak in the interest rate cycle or the low in bonds and notes. And I think that as the year progresses, we'll start to see that shift and see interest rates start to pull back and bonds and notes start to move higher into that mid-2024 cycle peak.
Do the war cycles predict when wars will begin and end?
They don't. I don't think any cycles of that magnitude are typically that precise, although there are often momentous events that occur on cycle anniversaries. But for something like that, I had discussed for many years before late 2021 why I thought an 80-year cycle of war that dates back not only through America's history, but back through Europe's history. I traced it back to the early 1300s, and it wouldn't surprise me if it even went back earlier than that the major conflicts, the major wars were on this 80. Kind of makes sense, too, from a generational perspective, from those that don't learn the lessons of history are doomed to repeat them type of approach. That makes a lot of sense that an 80-year cycle would be so precise in timing those war cycles. And that's why I kept saying that late 2021, 80 years from when the U.S. in particular entered World War II in late 1941, but really when that war ramped up. And that was 80 years from 1861 when the Civil War began in the U.S., and that was 80 years from 1781 when the Revolutionary War, War of Independence, whatever you want to call it, was culminating, and basically the U.S. as a nation was beginning. So for the U.S.'s history, even though that's only a few of those 80-year cycles, but that has moved in lockstep with that 80-year cycle. But like I said, Europe has been involved there in one way or another, dating back to the early 1300s. And so that's why I kept saying, look at late 2021 through late 2025 as the time for the next major war cycle to begin. And November, December 2021 was when all the rumblings started of Russia amassing troops on Ukraine's border, and it just went from there. But I've also pointed out why I think that's only one phase of this war cycle, and why there are cycles related to China that I have detailed, and that could be something surrounding the South China Sea, Taiwan, could be various things, but that China has corroborating war cycles coming into play in the next few years, and there's also the Middle East in 2023 that has a very consistent cycle that I'm watching. So I certainly think it's a time of continued and repeated upheaval and tumult that we're going to see, and that may be one of those factors too that reinforces what I just described with gold having more 6 to 12 month swings, and with the stock market having those types of swings, that if we do get a series of conflicts, and then, whatever happens in them, and then whatever resolution or at least receding of those tensions occurs, the markets swing with that. That may be one of the driving forces to these market cycles that I'm discussing.
Have Bitcoin and the cryptos completed the bubble bursting scenario you described in late 2021? If so, what do you expect now?
Well, when I was describing that leading into November, December of 2021, which was the culmination of several cycles in cryptos, and more importantly was the culmination of a 5-wave uptrend that Bitcoin had been tracing out in the years leading up to that. I was describing how Bitcoin needed one more spike high back up into that 66,000, 67,000 price level. It ultimately spiked up to 69,000. But at the time I discussed, I've since then published a series of downside targets that were really going to be the definitive measure for me. And the first one, a 2 to 3 month downside target, was right around 40 to 45,000 in Bitcoin. Then the 3 to 6 month downside target was down around 29,000. But the ultimate downside target I had for Bitcoin was for it to at least reach 18,000 and potentially spike below 14,000 before it would bottom. It has certainly fulfilled that 18,000, dipped down into the 16,000 range, but there's still, until certain bottoming signals are, until they unfold, there remains the potential for a final spike low. There's a lot of things that Bitcoin did as it was dropping below 18,000 that were showing signs of a bottom, but it has not given the subsequent confirmation yet to have me completely eliminate the possibility of a final spike low in my analysis. So we've certainly seen that bubble bursting, as I described, over the last year or so. When you look at some of the modern day bubbles, including Japanese stocks in the late 80s and then 90s, including the dot-com bubble in late 90s and into early 2000s, even a similar bubble that I talked about in gold stocks leading into 2010, 2011. Each time the governing markets lost 80% of their peak value. And so I was looking for a similar thing in Bitcoin, which is about what it has done with its late 2022 spike lows. So even from just a general bubble bursting perspective, you've got a parallel between Bitcoin and some of these other bubbles of the last 30 to 40 years. So there's certainly a lot of things that say any remaining downside potential is very limited, but I haven't yet gotten on a hyper bullish train yet either.
For many years, you described drought cycles that you said would accumulate in 2021. In October of last year, you went on record stating this winter, 22-23, would see a massive shift in precipitation for California and be one of the rainiest years in decades, even though most meteorologists were calling for continued drought. Has the recent California flooding fulfilled that, or do you see more?
There's a complicated and a simple answer to that. Let me say I do think that from the cycles that I was citing back then and that I've described really since 2015 to 2017, and I'll elaborate on them in a second, but I think there certainly is the potential for more rain, more forms of precipitation, more drought alleviation. Once the snowpack starts, once they start giving final tallies of that in April. But again, to go back to the broader perspective, since 2015, 2016, 2017, I've been describing how, along with this uncanny 40-year cycle that I've seen in currency wars, in geopolitical realms, that I also saw something very similar in drought cycles that ultimately give way to deluge cycles. And I explained then why I thought that And some of this was focused on California and the western U.S. because of how critical that is in crop raising, in food and potential food crises for not only the U.S. but for much of the world in certain crops. And so that had some of my primary focus, but I explained how these drought cycles, that they should see a final upswing from that 2017 when California had gotten a year of rain in 2016. But a final part of the drought cycle should surge into 2021, and then you would see the transition time in 2022 from those drought cycles to what I called deluge cycles. And you can just go back even over the last 100 plus years, not just in the U.S., but worldwide, and on a very consistent 40-year cycle, you have these major droughts. You can go back to the 1850s into 1860s when you had the Civil War drought, which was impacting the U.S., but there were corresponding droughts around the world. And then in the 1890s, you had also worldwide droughts, which one of the most significant being the Federation drought in Australia. And that drought lasted through the end of the 1890s into 1901, and then things turned around in 1902, or began to turn around. Then in the 1930s, you had the Dust Bowl, and the final really bad Dust Bowl year was 1941, and then things turned around began to turn around in 1942. Then in the 1970s, particularly California, but in many other areas as well, you saw extreme drought in the late 70s, and that gave way to a turnaround in 1982, 1983, when California had two of its wettest years on record. So on a very consistent 40-year cycle basis, the late 1850s, 1890s, 1930s, 1970s, and 2010s, you have those extreme drought cycles, and just as consistently in 1862, 1902, 1942, 1982, 83, you saw a shift and a turnaround and the alleviation of some of that drought. And so all along that 40-year cycle has had me describing why I thought 2022 into 2023 would see a very significant shift for California, for the western U.S., and that precipitation would even carry inland, obviously. But, what you're referring to, back in late October, I wrote, and here's just a quick quote of it. I just pulled it up in front of me. It said, 2023, 2024 is when cycles project a shift after reaching new extremes. One of those shifts could be seen in the West. Parenthetically, as goes California, so goes the U.S. I wrote, based on analysis of a consistent 6-year cycle, a sunspot-related 11 to 12-year cycle, and a 40-year cycle, as well as these other ones that I'd previously described, I expect California and other parts of the West to see an abrupt turnaround in precipitation during the 2022-23 and 2023-24 rainy seasons, or as they're called, water years. And as you mentioned in your question, I was kind of monitoring all the mainstream meteorologists. They're all saying another year of less than average rainfall, that the drought's going to extend, and it was more just a linear extrapolation of what had gone in the years before. And, I continue to contend that life is cyclical, it's not linear. And so going back to that late October analysis that I published for my readers, I pointed out, in recent decades. Heavy rain years arrived in 2017, which was the highest total since records began. 2011, 2005, 1998, 1993. So on a very consistent 6-year basis, all those pointed to 2022, 2023 as a prime candidate for increased precipitation. Then I detailed the 11 to 12-year cycle and showed how 1941, 52, 63, 74, 86, 1998, and 2011 produced surges in precipitation averaging at least 35% above the annual average amount. So you had this synergy of cycles coming into play. The next phase of that cycle was pinpointing 2022 to 23 and 2023 to 24 as prime candidates for a strong upsurge in precipitation. And then I went back to that 40-year cycle, and I wrote that is also when a 40-year cycle comes back into play, linked to increased rainfall in the early 1900s, early 1940s, early 1980s, following extreme dry years in each of the preceding decades. Following the 76 year of extreme drought, 1982 to 83 saw consecutive water years of extreme precipitation, combining to create the greatest 2-year period of rain since records began in the late 1890s. 2022-23 and or 2023-24 could repeat this pattern and perpetuate that 40-year cycle. So that was what I was writing in late October, which was just reinforcing what was described in 2019, in 2017, and it was all concluding the same thing, that this winter was the winter when California and the western U.S. should see a dramatic turnaround in precipitation. And I should stress, as I do in my written publication, I'm not a meteorologist, I'm not a weather scientist, not a climatologist. I just observe and study cycles and the impact that they have and the consistency that they have. So all of my work was showing that we're entering a period of deluge, just like has occurred on a very consistent basis on several different time frames. And it's the synergy of all of them coming together in this 1 to 2 year period. I also described why I thought an El Nino cycle would probably come back into play next year, in 2023 to 2024, and that could have an impact on this. And all those things have much greater impact and repercussions than just California or just the western U.S. It also times perfectly with the culmination of grain price cycles that we're projecting major peaks in 2022 and other related commodity and inflation cycles. And so these things are very closely intertwined, although they don't always have a direct cause and effect, but they are symptoms of broader factors that are triggering this change and these shifts in cycles. So yes, I do think that we've still got more rain and precipitation to come. That doesn't mean all at once, doesn't mean next week. But from this overall cycle perspective, I do think that we are seeing a significant shift, at least on a couple-year basis.
How are agricultural cycles connected to future retail food prices?
Well, there's a lot of often lag and lead time in those agricultural cycles when they flow through to the store shelves and retail food prices. Often, same thing with energy sometimes, although energy reacts faster a lot of times when the price is going up. But often with even other commodities that companies that produce and process those commodities will often try to hold off price hikes as long as they can. So often you'll see ag cycles and ag prices start to move higher, but it doesn't immediately flow through to retail food prices, but then you get kind of that, breaking of the dike, or just a parabolic move, a crossing the Rubicon type of thing, where all of a sudden, when those agricultural cycles hit the accelerated phase, then all of a sudden you see these extreme moves in retail prices and everything in between. And so I think that's what you've seen in the last year or so with retail prices for so many things, that the underlying commodities were steadily moving away from their lows for a couple of years, but then they entered the more accelerated phases of their trends, and that's when all of a sudden you get this whole inflationary surge over the last 1 to 2 years.
What's the latest on crude, gasoline, and natural gas?
A lot of your energy cycles are certainly at a significant turning point when they are showing signs of bottoming. I think that natural gas could be at a very significant bottom that I was looking for here in the January-February time frame. But I don't think that that's going to necessarily trigger an immediate parabolic surge or anything like that. It's just that we have expended most of the downside energy, and now it's the opportunity for some bottoming and some steady uptrends to start to form. So I do think that energy markets are going through that bottoming phase, and it's probably going to be a couple month process before they are in a position where they could see a more prolonged or consistent trend to the upside.
Eric, are there any other cycles we should be keeping a really close eye on?
Probably the one other that I have been discussing in my newsletter, and I hesitate when I discuss it because I think it's one of those things that I definitely need to give caveats with, that it's not a sky is falling type of thing. Often some of the things I discuss are taken out of context by people with an agenda and really magnified to a degree I don't intend. But one of the things I have been describing for the last 2 years is why I thought that 2023 was the highest probability from a cyclical basis. And again, I would give the preface that I'm not an astronomer or a solar scientist, but I think it's cyclically the highest probability for a pretty disruptive solar storm. And you've seen those type of storms on several intervals. It's kind of like we were just talking about with climate and precipitation, that there's a very consistent 11 plus year cycle, which is identified as the sunspot cycle. Scientists kind of average that out to an 11.2 year cycle, even though it varies widely around that number, but that's about what it averages out to. But I've shown where I'm convinced there are a couple of other critical cycles impacting solar storms. A 17-year cycle, which just in the last couple months, there's been some articles coming out validating that exact cycle that I've been writing about for 20 years now, and why it has an impact on solar cycles. And a broader 40-year cycle that they've now identified as they call it the Great Conveyor Belt of the Sun, and it has to do with how not only the polar shifts of sunspots, where they They go from one pole to the other in each subsequent sunspot cycle, but how they're swept up along the surface of the sun and then deposited to those poles. Bottom line is, it ends up creating a pretty consistent 40-year cycle. Well, all of those cycles linked to previous major solar storms come into play in 2023 and slightly lesser in 2024. So that's a cycle that I've been discussing for a couple years now, and why I think we could see a significant solar storm in the coming year. I don't know exactly when, don't know what or where that would impact. It's just analysis on the intervals and the frequencies and the consistencies of those solar storms. So that is one other significant cycle that I think deserves at least a little bit of attention.
Right, and if people don't think solar storms can affect you, the Great Northeast Blackout of 1965, solar storm knocked out all the Hydro-Quebec stations, and the original one we know about, 1859, the Carrington event that melted down all the telegraph stations. And those were the only electronics back then.
Yeah, and you've had throughout, I mean, there was a major one in 1921, another one in 1938. There was one called the submarine storm that triggered a massive military. It came within one step of being a military response, but where the military thought that there was some sort of attack because of the results of these solar storms. You had the Bastille Day storm of 2003. There was another storm right in there, like you mentioned, the Quebec one in 1989. There was one it's either in the 90s or early 2000s that disabled all of the on-site payments, particularly, I don't know whether it was a specific satellite, but particularly with a lot of gas stations. And all of a sudden your ATM debit card, credit cards couldn't be used. It was only for a short period of time. It was quickly resolved, but the 11-year cycle there, that I point out to a lot of my readers is something that most of us went through unaware of, but in 2012, which was the next phase of this 11-year cycle, which then projects to 2023, the sun exploded with a storm that, to their best knowledge, the scientists that monitor and study that say that particular storm was the magnitude of the Great Carrington event of 1859, but the sun was not aiming that storm directly at Earth. It was an 8 to 9 day difference. So if it had happened either 8 or 9 days earlier or 8 or 9 days later, I forget which, we could have been contending with a solar storm on the magnitude of the 1859 Carrington event. So just because nothing significant happened on Earth in 2012 from a sunspot perspective or solar storm perspective didn't mean that the sun wasn't continuing to generate these major storms on the same intervals, the same cycles that it's been doing for centuries, for millennia, and potentially well before then.
Eric, where can people follow you and subscribe to Inside Track?
They can get a lot of that, or the majority of that information, on our website at InsideTrackTrading.com. Again, that's inside with the extra I in the middle, so it's INSIIDE, TrackTrading.com.
Eric, thank you so much for being on the show.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. He was speaking to us from California. Coming up, Martin Straith, next on This Week in Money.
RecycLiCo, making lithium-ion last forever. RecycLiCo's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. RecycLiCo Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMY.ZF, and Frankfurt ID4. For more information, visit RecycLiCo.com or phone us at 778-574-4444. RecycLiCo, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, British Columbia, which is just east of Vancouver. Martin, welcome back to This Week in Money.
Well, thank you, Jim, and Happy New Year to you and your listeners.
Can you tell us a bit about Trend News, the letters you publish, and how people can sign up for it?
Oh, you bet. Well, we have 3 publications. We have the Trend Letter, which is in its 21st year. So it publishes every Sunday evening, covers equities, currencies, precious metals, commodities, and bonds. Each weekly issue is about 50 pages, mostly charts with key bullet points to make it really easy to understand. So the whole thing's like a 10-minute read, and you're up to date once a week. Audience focus there would be longer-term investors, people who want to get a better understanding of what drives these markets. Our second service is Trend Technical Trader. It's an online service that we started as a hedging service, which has been very timely during this current bear market. We expanded it, though, so now it also does lots of long positions, covers many sectors, including commodities, equities, precious metals, even psychedelics. Audience focus here is for more active investors, but certainly long-term investors can also benefit, especially with those hedging strategies. Third one is Trend Disruptors. So that invests in disruptive ideas. So we're talking artificial intelligence, virtual reality, augmented reality, 5G, cloud, Internet of Things, all of those cool things. Obviously a very speculative sector. And given this bear market, we have not even made any recommendations for the last number of months. But we've built a really good, solid watch list, now over 35 companies. And we are looking to buy when we get our next trigger, which we think will be not too distant future. Audience here, people who are willing to invest and speculate, but only with risk capital that they can afford to lose. To subscribe, go to thetrendletter.com. So that's all one word, thetrendletter.com, or email us at info@thetrendletter.com with any questions.
You're going to be speaking at the World Outlook Conference in Vancouver, February 3rd and 4th. What topics do you plan to talk about, and how can people attend? Yes, well, that's the Money Talks annual conference at the Bayshore Inn in Vancouver. The cool thing there is it's in-person conference. I think the first one since the pandemic. And we love that in-person format because you get to interact with the investors and talk about all kinds of different ideas and seriously, answering their questions, which we found to be one of the best parts of the whole thing. Hopefully some of your listeners can drop by and chat. We talk about everything. I mean, we'll have our different group there, so all 3 services are covered. So it's really what anybody wants to ask about, we're there to answer. You can get tickets by going to mikesmoneytalks.ca.
Martin, do you find one of the good things about a conference like that over Zoom or other social media contact is that it's not just talking to people at the desk, but then you go for lunch or you go for dinner. There's hospitality suites, and people have told me more business gets done in the hospitality suite than on the actual convention floor. Is that true?
Oh, the last couple of those conferences have been virtual. So yeah, we do the Zoom thing. We record stuff, but there's no interaction. And that's the key to me is, we've all seen presentations, and when you go to a conference like that, it's a lot of presentations. It's quite tiring. But, what we find is that when the people are coming, just mingling around and they come and ask, they got these questions that have been burning them. They've seen some of your material or they've seen some of your presentations, but they didn't quite maybe understand some piece of it. And it's fantastic. It's, people get to ask the questions that they want, and we get to find out, we get to hear their questions too. And that's the best part to me. I think there's like 1,500 people are at this one. And so you get a real nice variety of what people are thinking, what they're worried about, what they're excited about. So, yeah, it's a fantastic format.
ChatGPT, what is it, and what do you think about it?
Yes, well, that's certainly the real buzz around that app right now. This is a big step for artificial intelligence. This application has a remarkable ability to interact in conversational dialogue, and it produces responses that are very human-like. So you can pose it questions, ask for help. You could discuss anything. You could discuss philosophy with it, and you will receive useful and very interesting responses. Some of the things that it can do and has done, you could ask it, compose a 600-day or 600-word essay on Middle Ages. You could ask it to look at your programming code. We were talking earlier there, Jim, just offline about, programming code and finding different errors. You can actually ask this app to review your programming code and identify errors. And you can even play tic-tac-toe with it. Even the CNET, which is a technical website, they have actually used this app to actually write some of their technical online articles. So this technology clearly has the potential to be very disruptive. And this is why big tech companies are paying so much attention to it. Microsoft has already invested heavily, and they're planning to use this app right into their Office suite. So this Chat GPT, it can directly provide information for users. So here's an example. So you can type in a question, and it will answer the question for you. So now compare that to Google search, where you type in your question, and it provides you with a list of links where you can then click on whatever one you think, you can pick on the top one, and hopefully dig out the information that you're really looking for. So this could be a huge game changer because, Google owns the search engine market. But if we get AI apps like ChatGPT, this is the potential to eliminate that whole business model. And in fact, last month, Google has had some emergency meetings where they've actually brought in their original founders as they see that this app is the first real threat in decades to their $150 billion business. Jim, this is big. Now, while it all sounds exciting, and it is, it really opens the question as to where AI is taking us. To me, one of the huge benefits of writing an essay or an article or a blog is that it makes us think. For students today, there's already so many shortcuts to get quick answers. And then you've got an app like ChatGPT. It potentially can remove much of the thinking required from the student. This app, it's only been out, available. It's just in a trial process. But it's only been available for a little over a month. And already many schools are starting to ban it. We've got teachers that are now making students submit handwritten assignments done in class to ensure that there's no cheating. There's also in Princeton University, they developed an app that will assess the likelihood that any text it analyzes was crafted by another AI bot like ChatGPT. So make no mistake. There's no stopping this development. It's a game changer. Now, one of the big risks here is AI apps have deep biases. They can have deep biases depending on the data set that they've been trained in. So already we've got ChatGPT has already been accused of filtering out any role nuclear or fossil fuels could have in a global energy solution. We've got the European law enforcement group called Europol, and they're predicting right now that in 3 years, 90% of all online content is going to be generated by AI. Now, Roger in our Trend Disruptors team, he recently posted an article on the topic. It's up on our website. It's well worth a read. And by the way, yes, Roger is a human. But in the blog, what he's asked, one of the key questions he asked is this the real start of bots doing our thinking and our work for us, causing humans to stop thinking for themselves and to stop doing the work needed for organic learning in our brains? So, June, I mean, this is a fascinating area. There's going to be a lot more to come in this space for sure. Our Trend Disruptor team is covering it. They're all over it. So, going to be very exciting.
Is there any way for a person to know they're talking to a robot instead of a real person? Perhaps, tell it a joke and see if it understands it? Or would it be able to?
There's certainly been some misinformation. So, I haven't tried it yet. We've got our name in there. You have to kind of get on our waiting list. So we haven't actually been able to try it yet. But from what I've read, it does allow you for, that if you ask a really specific question and you know the real answer, if that answer is not readily available on the internet, because basically these things just, the content, and this is the real risk, I think, the content that they're using to come up with their answers is the stuff on the internet. Well, if that stuff is, is heavily biased, if you're heavily biased on it, you could talk Trump or something and you can get something there. Well, the answer coming back might not actually, if you drill down, it might not be the actual proper answer, but because there's so much, negativity about that name, you actually may not be getting a true answer. But I think that, this is really early stages. I think that what's going to happen is these things will get smarter and smarter and smarter. Potentially, and again, if you don't have guardrails on it where you're creating biases on what it's going to, respond to, I think that you're going to find that, already it's, one of these things is done where it's actually passed the first two medical years of medical exams. So you got to think that the potential here is pretty dramatic. But, would you know? I would bet that at first you might find the odd little glitch here or there, but the fact that teachers are having to, make students do handwritten. One of the big things that the teachers, what they found is that the answers in the reports were too good. They knew that student. There's no way that student was that good. So these are the kind of things that, they know that it's not a true response from that person, but they probably wouldn't know if it was an anonymous response.
The Russia-Ukraine war is being blamed for inflation. Your thoughts?
Well, all during the bull market over the last 12 and a half years, the mantra's been, don't fight the Fed. And so remember that the Fed wanted inflation at 2%, but even at those low rates for 12 years, they couldn't get there. But those low rates made borrowing so much easier, and so that the stock and housing markets were the big beneficiaries of all that cheap money. And then we had COVID hit, and, governments responded by locking down their countries, which basically shut down the whole global supply chain, seriously cutting supply of, food, appliances, computers, energy, you name it. And then, because so many were now not able to work, governments then responded again. This time they started handing out trillions of dollars of stimulus checks. They're handing them out like candy. And the result was the U.S. savings went, now you can get these numbers here, they went from $1.45 trillion in late 2019 to a whopping $4.85 trillion in mid-2020. I mean, that's an increase of $3.4 trillion, or 234% in just 6 months. So you've got all that money handed out, and it's created new demand. So we know that supply chains are down, so now you've got too much money chasing too few goods. So the result is inflation started. So we now have a reduced supply of all kinds of goods, and we've got increased demand from all these handouts. So now we've got this new wealth effect. So you've got people who had never invested before started buying stocks. I mean, Jim, you remember, the whole Reddit crowd started buying GameStop and AMC. Well, that pushed inflation even higher. So from September 2020 to December 2021, so we're a little over a year, we saw the S&P 500 rise 50%. And then by January 1, 2022, U.S. inflation was already at 6.8%. A month later, it was at 7.5%. And then Russia invaded Ukraine, which compounded the whole supply chain problem, especially in agriculture and energy. So inflation, though, was already a serious problem before the war. We had low rates, COVID lockdown, shut down the supply chain, and massive stimulus equaled inflation over 7.5% before the war. So certainly the war contributed to the inflation, but it was definitely not the root cause.
Almost every day the markets react to good news as though it was bad and bad news as though it was good. Any idea why that happens?
Yeah, the whole bad news is good news theme, it's based on the belief that the Fed, or Bank of Canada, has investors back. And so the mantra is, don't fight the Fed. So for 12 years, bad news was the weak economy. The good news was, the Fed will keep interest rates low. So low rates then meant that tech companies had easy access to money to spend on research and so on. And it also meant that investors could borrow at almost zero rate and invest that money, which then created more buyers for stocks. So the end result was tech companies, those stocks, ended up leading that 12-year bull market. Jim, it was party time, and the Fed was sponsoring an open bar, basically. So then we had COVID lockdowns. So that shut down the supply chain. We had the stock market crash then in 2020. So all of that bad news, but then the good news was that the government came in and handed out trillions of those stimulus checks, and the Fed kept rates low. Then more bad news. Inflation started to rise, but the good news was that the Fed would keep rates low, saying inflation was transitory. So the result was, after that dramatic stock market crash from COVID, the stock markets recovered dramatically in 2021. It wasn't until the start of 2022 that the market started to realize that the Fed was wrong and inflation was not transitory. It was starting to rise dramatically. Then, of course, we had Russia invade Ukraine. So at that point, the Fed and Bank of Canada started to raise rates. So then the markets fell into a bear market. So at that point, we had bad news was actually bad news. Inflation was rising, bad. The Fed was starting to raise rates, also bad. So then, we've got the Fed starting to tighten so much, then the fear, of course, became we're going to fall into a recession. But then the market started to go, the bad news, let's treat the bad news as good, because if we're going to a recession, then that's bad. But that would mean that the Fed will need to pause or even pivot and cut rates. So, for the last number of months, every time we see inflation rate dropping, and the market saw that as a recessionary, the rates have been up so much that it's now starting to hammer on to the economy. Well, that's bad news. But that created the hope that the end of the hikes and even cuts was going to be good news. And, Jim, that's the world we live in right now. It's, until we kind of work through all this, recessionary stuff, it's almost a daily game of, that's bad data. That means the Feds can stop raising rates. So that's where we're living.
What's the latest on the bond market?
Well, it's very interesting, actually, what's happening in the bond market. Bonds and yields move opposite. So if bonds go up, yields go down. Yields go up, bonds go down. And investors buy bonds when they think the rates are going to go down because they want to lock in at the higher rate. So while the Fed sets the short-term rates, the bond market sets the longer-term rates, and it tends to lead the Fed. It's, predicting what the Fed's going to do. So recently, we've had the bond market betting that long-term yields are going to decline while the Fed has been raising short-term yields. So this results in what's called the inverted yield curve, which has been a very reliable predictor of a recession. So the bond market is calling for a recession and betting that the Fed may soon have to stop raising rates. That's that bad news, good news story. So now, counter to what the bond market sees, we know that both the Fed and the Bank of Canada say that they want the real rate to be positive, meaning they want the central bank rate higher than the inflation rate. So, right now the U.S. central bank rate is 4.5%. Their inflation rate is 6.5%. So their real rate is a negative 2%, not a positive. Canada's central bank rate is 4.25%. Inflation is 6.3%. So their real rate is a negative 2.05%. Again, not positive. So if these central banks are going to be true to their word, then rates will either need to rise or inflation needs to drop to get to that positive rate. So just for your listeners as investors, while we do not recommend owning any long-term government bonds, we have been recommending to our subscribers recently that short-term bonds, so 6 months a year, paying 4.25% up to 5%, makes a lot of sense as a conservative investment short-term.
What do you see ahead for the U.S. dollar and the Canadian loonie?
Well, from June 21 to September 22, the U.S. dollar jumped a whopping 27%. Investors need to understand that a strong U.S. dollar is a real challenge for many countries, especially emerging markets. Because when the Fed was keeping their U.S. rates near 0%, a lot of these emerging market countries issued over $10 trillion of debt denominated in U.S. dollar. And now, as this debt is coming due, these emerging markets and companies need to pay the debt off in a much more expensive U.S. dollar. So the exchange rate from their local currency to the U.S. dollar is much higher. So this is really going to put a lot of pressure on some of these sovereign bonds. We've been warning our subscribers for a couple of years now that, we're going to hit a global sovereign debt crisis. And so what we're seeing now is that many of these central banks around the world are coordinating an effort to try to reduce the value of the U.S. dollar so that this debt exchange ratio isn't so extreme for them. So since that high in September, all these central banks have been selling off the dollar, and it's been working. The dollar's fallen about around 10%. Now, it's also fallen down below our recent target of 103. It's trading today, I think, about 102. But it's getting very oversold. And, longer term, we still see the U.S. dollar being strong. There's still, unfortunately, there's going to be a lot of more geopolitical problems. People seem to think that the war in Ukraine and Russia is going to be over anytime soon. I kind of doubt that. You've got China, Taiwan. You've got a lot of problems still out there. And when things get dicey, the U.S. dollar is the place to go. Now, on the loonie, the loonie just basically plays opposite to the U.S. dollar, as do most currencies. The Canadian dollar also is very interesting. It has a very tight correlation to the S&P 500. So you take a look at that. It's quite interesting. So if the stock market's going down, the Canadian dollar is probably going down. If the stock market's rising, the Canadian dollar is probably rising. It's been trading in a tight range. Support is around 72 cents. Resistance is around 76. And again, if the U.S. dollar is up, the Canadian dollar is going to go down. If the U.S. dollar goes down, Canadian dollar is going to go up.
What do you see ahead for the euro and yen?
Well, first of all, I think that, as we just talked about, that the, U.S. dollar jumped 27%. And that strength in the U.S. dollar pushed the yen down to, what is a 32-year low, I think, in October. And with that strength, in the U.S. dollar, central banks around the world, and particularly the big guys, so China, ECB, Bank of Japan, they started selling the U.S. dollar to boost their own local currencies. And then, interestingly, a few weeks ago, the Bank of Japan stunned the market when they tweaked their bond control program that would allow long-term yields to rise. I mean, they'd gone almost 2 decades of suppressing their yields. And why did they do that? Well, with energy and food prices being so high, Japan being a big importer, the cost of these items was crushing the Japanese consumers. So since this intervention, since that 32-year low, the yen has jumped almost 17%, I think. But this week, very interesting, the Bank of Japan again surprised the market, this time by not raising their rate. So they left their central bank rate cap at negative 0.10%. This is really interesting what's going on here. So if they keep that cap on their central bank rate, it's going to force capital out of the Japanese bonds, and it'll probably move into the U.S. Treasury securities and other foreign assets. And it's going to hurt the yen. So, we're really watching this because it's almost like the Bank of Japan. They made that big move a few weeks ago, and now the market was totally expecting them to raise their central bank rate, and they did not. So we're keeping an eye on it. Now, for the euro, similar story. It dropped about 23% from its high to the 2022 low. But since that October low, the euro is now, it's up about 13%. Now, again, the ECB was selling in the US dollar. And, I was listening to Lagarde today. I mean, she's talking very hawkishly about inflation and suggesting that they are going to be more and more aggressive on their central bank rate. So, when these central banks, if they're going to raise their rates, investors will put money into that currency because it's, right now, I mean, the U.S. dollar had that huge run up because the Fed was more aggressive than all the other central banks. Now everybody's expecting the Fed to back off, and if the ECB is going to continue to be aggressive, then and same with the Bank of Japan. I mean, the Bank of Japan's a bit of a unknown right now, but the euro is definitely probably going to keep rising a bit unless the U.S. raises rates at their next one.
When you were last on the show, you said you were bullish on gold. Gold's had a big run since then. What are your thoughts on gold now?
Yeah, gold's had a terrific run here. Back in November, we sent out a thing to our subscribers noting that gold was forming what we'd hoped was going to be a strong basing foundation, and that's turned out to be correct. So since that November low, gold has nicely broken through a series of our targeted resistance levels. So the first one it broke through was 1730, 1775, 1825, 1875, and 1910. A really nice, smooth, hits those resistance, hangs there for a bit, next one and next one. So right now it's sitting at about, last I looked, it was 1930 today. So, gold is, technically getting very oversold here. Overbought. Nothing moves straight up or straight down. So, right now, the latest move on gold, it would be good for it to have a little bit of a correction here, catch its breath, so we don't get a really extreme, correction. So what I'm looking for here, right now it's 1930. We're looking at 1875 as the initial support level, with very strong support at 1780.
What are your thoughts on silver?
Well, very similar to gold. Gold and silver generally move together, silver being the more volatile of the two. So silver typically will fall. It'll actually rise. It rises faster in a bull market, and it declines faster in a bear market. So, for example, when we saw gold from that November low, it's up almost 17%. But silver is up almost 34%. So it's double the gain. So, we typically see that. It doesn't always happen. And right now the gold silver ratio is still high. So meaning gold has been moving. But this last, run, silver had a nicer run than gold. But silver just sort of tailed off a bit more than gold in the last couple of days. So we're going to keep an eye on that because you want to see silver do better. If silver's doing better, then the two of them will generally do better together. Silver currently is, 24.10 I saw today. Again, both of them have formed a nice base pattern. Near-term support for silver would be about $22.30. Strong support would be the $18 level. But longer term, we see significant run higher for gold and silver in 2023.
Previously, you called for crude to hit $150, even $200 in the next 18 months. Are your models still forecasting these targets?
Yeah, in that time frame. But shorter term, we still see some challenges for oil. Oil is driven by, supply and demand. So China lockdown was a big headwind for demand for oil. Plus, if we do head into a recession, that's definitely going to cramp demand. So until we kind of work our way through this whole potential recession issue, oil prices are likely to trade in a range, from maybe down to the mid-60s up to, say, 90 or the mid-90s. Currently today, last I looked, it was 81.50. So if we do see oil in that $65 range, that should be the bottom, and it would be a great buying opportunity. Now, longer term, we see much higher prices for oil starting in 2023. China's starting to reopen, which certainly is going to help on the demand side. And on the supply side, you've got governments, they've been imposing their windfall taxes, tight regulations, no new drilling permits. These are all major disincentives for producers. Jim, it's classic, the governments kick in and they want more oil, but they put all these restrictions. So we've got capital expenditures in the oil sector are at 35-year lows. So this lack of investment in the sector is going to cause serious supply problems longer term. Jim, I am all for greener energy, but we need to be realistic on the time frame. We're going to need fossil fuels for much longer than these governments are projecting. So longer term, yes, we see oil up in that $150, even $200 level in the next 18 months.
Yeah, governments want to jump right into electric vehicles and so on, but just look at how long it took us to switch from horse and buggy to automobiles. Even in the Second World War, the German army was relying on horses to tow their artillery and transport troops and supplies. So, I don't think they've really allowed enough time to change. Technology's taken a long time. There are still people today who don't know how to use a computer, and computers have been around quite some time. The change takes time, and it also costs a lot of money.
Well, and it takes a plan. I mean, my background is project management, and you have to have a plan to do this, and you don't, if your plan is, at the end of the thing is that you have clean energy and you have no fossil fuels, well, you don't start shutting down your nuclear plants and closing down on your natural gas supplies and, doing all those things before you have your alternative even built. So the timing it drives me crazy when I see this. I mean, it's almost like, if you question their plan, which they don't seem to have one, then you're considered like, you're against green, which is crazy. I mean, who doesn't want fresher air and cleaner water? But you have to have a sustainable plan. And right now, I don't think we have one. And so as an investor, I think oil and fossil fuels are going to be around for much, much longer than any of these people think.
Look at how long it took us to transition from sails to steam to diesel engines in our boats. Thousands of years.
Well, and then you can also, don't go on forever on this, but, just the base materials that you need to build this, this green infrastructure. Windmills need a ton of, materials. Batteries, these cars, an EV car uses a lot more copper, a lot more, it needs lithium, it needs, cobalt, it needs all of these materials. Well, there's no new, mining permits happening. So, I've seen, estimates where we need about 4 times the number of copper mines just to meet the demand. Well, where are these mines going to be built? So again, if that's the goal, then you need all of these milestones and these plans to start building all of these new mines. And, the those mines are powered by what? They're powered by fossil fuels. So, it's a great goal to get to, but if you don't have a plan, you're never going to get there.
Stocks have started the year positive. Are you buying now?
Well, I mean, we've been long for years, but what our strategy has been, since COVID, is we've been just using hedge positions on and off as we see a top, and as our models tell us that the market's probably going down. We'll just apply some hedges so that protects our long investment. And when I say hedge positions, Jim, I'm talking about very simple trades using exchange traded funds. Just like you would trade any other stock, it's just a click on the thing and off you go. So it's not, you're not having to short things. You're not having to get into the futures markets or the option market. It's just simply using some tools that are very, very effective at doing, very quick. You can cover yourself, and then when we get the long, we sell that, that short position. We sell that ETF, let the market go again, and then if we see it at top again, then we will apply it back down. So there's lots of really good strategies to use there. So as we discussed earlier, we got this real bad news is good news is bad news mantra in the markets. So it's all based around inflation, recession, Fed, hiking, pausing, or pivoting. So our work is technical, so we just go by the charts. And these tell us what the market is doing versus what everyone thinks or wants it to do. So 2022 was a rough year for bullish investors, and I'm thinking at the least the first half of 2023 is likely to be very volatile as well. Our models look at many indicators. One that's your listeners might be really interested in, really short-term one, is that when the VIX volatility index drops below 20, we typically see a temporary top in the market. Last week, we highlighted to our subscribers that the VIX had dropped down to 18, and so expect the S&P 500 to drop this week, which it has done. It's up today, but it's down for the week. So these kind of indicators are very clever. I mean, they're very easy to see, and that's where charts really come in. You can just see when this happens, that's happening. When this happens, that happens. And again, I will be posting charts in my market notes, and your listeners can just go onto our site and read that. You can see some of these things, and the picture is really worth 1,000 words there. So we're open to the market moving higher. They're up so far in January. If the markets can close the month higher, that's generally a bullish indicator for the year. Key resistance right now for the S&P 500 has been 4,000, and the S&P has tested that just recently, but it could not break through. So near-term support would be 3850, then 3770. Key support is 3570 level, which was the September and October double bottom. One thing your listeners need to really understand is that typically the bottom of the market aligns when the Fed stops cutting rates, not stops raising rates. Well, the Fed's still raising rates. And so when they do pause and stop, they'll probably hang there for a while. Now, but you're going to hear all this, you're going to hear all the TV pundits going, well, there it is, it's time to buy. Well, that's not how it looks, in the technicals. So when they start to lower rates, that's still typically not the time to buy. It's when they've actually lowered the rates and they quit doing it, that's when the markets tend to bottom. So again, in my market notes, I will post some of these charts for people to have a good look at that. That's that chart, you won't find it very often. Nobody else seems to compare it, but we use that a lot. It's a real key indicator for us.
What do you think the Bank of Canada is likely to do this week?
Well, I mean, guessing what, central banks do is kind of a dangerous game, but, both the Bank of Canada and the Fed say they're data dependent. So I see them raising rates, but starting to move from, the question of how much do we raise to whether or not we raise. So at this point, the bond market, I think we mentioned earlier, is still seeing a recession coming, and they are betting that the central banks do not need to raise rates much longer. Now, counter to what the bond market sees, we know that the Fed and the Bank of Canada both say they want real rates to be positive, meaning that they want the central bank rate higher than the inflation rate. So Canada, the central bank rate is 4.25%. Inflation is 6.2%. So the real rate is minus 2.5 or 2.05%. The U.S. central rate is 4.5. Their inflation is 6.5. So their real rate is negative 2%. So both countries have a negative rate. So if they're true to the word that they want to have a positive real rate, well then rates need to rise and or the inflation rate needs to drop to get that positive rate. So I can certainly see them raising another 25 basis points next week and maybe then pausing, and to see what the lag effect of all of these moves have been over the last year.
What would you say is the biggest obstacle for people being successful investors?
Well, there's many ways to analyze data and determine ways to invest. And if you don't have time to do the legwork, subscribing to services like ours can be great benefit and assist you in deciding if a certain trade's right for you. But ultimately, the biggest obstacle for any investor is going to be their emotion. Fear and greed are powerful factors that adversely affect, anybody's decision making. A couple of key indicators for investors to check their emotion. One is what we call the risk tolerance, or, it's risk tolerance, and really what we call it is the sleep factor. And the thing to ask yourself is, are you having trouble sleeping at night worrying about your investment? Because if you are, then you're too heavily in debt invested. And so you need to reduce your risk. To manage your risk, you need to have an exit strategy. And what I mean by that is before you buy any trade, decide how much you're willing to lose on that trade if the trade turns against you. And I guarantee you, some trades will turn against you. So we use technical support levels to determine our sell stops. Subscribers can use our sell stops or they can use their own. But the key is to have a plan to get out. The logic to enter a trade may be very sound, but you may be too early in that trade, or maybe the company had some unforeseen event happen. Maybe they had a strike or some regulatory investigation. Whatever it is, you need to have a plan in case you're wrong. Now, if the trade drops below your pre-planned sell stop, then sell it. Stick to your plan. So I'll give you here's an example. So let's say, first of all, you need to decide how much you're willing to lose on a trade. So let's say you're looking at this trade, everything looks good, and you decide, I'm willing to lose $1,000 on this trade if I'm wrong. Well, if the entry price is $10, and your sell stop, which again, determined by some support levels, is say $8, so 20% below your entry price, then you should only buy 500 shares. So the math would be 500 shares times the $10 equals a $5,000 investment. If the price drops that $2 down to $8, then you sell, and you sell the 500 shares times $8 equals 4,000. So you invested 5, now it's only worth 4, you lost 1,000. But if you have a plan, stick to it, because if you do, you will minimize your losses. And that's one of the keyest, most important things in investing is do not hold on to a losing trade.
Is that the biggest problem people have? They don't put stop losses in? Or one of the biggest?
Well, it's huge. Here's a classic. So let's say in this example, even if you listen to this today and you go, that guy makes a lot of sense. And then maybe you write it down. And then, a week from today, you buy a stock and you pay the $10. And you say, well, if it gets to 8, I'm going to trade. So let's say it goes up, it goes up to $11. Now you're feeling really good. And then all of a sudden it comes back to 10. And then all of a sudden the Fed does something or whatever. Now the market goes down. So it goes down to 9, and then it goes to 8. And then it actually, and you're sitting there at 8, and you're going, I think it'll go back. And I'm getting nervous. Yeah, I'm going to sell it. But I'm not going to sell it until it gets back to 10, and then I'll just get out. And that's such a common thing. And, I've done that. I've been investing for 40 some odd years, and, we've all done it. even though you thought you're going to sell it, you talk yourself out of that. And then it goes down to, $7.50, and then it's $7, and then that stock could just go down and down and down. And we've seen it, all these different market crashes. It goes down for reasons you may not even know what's happening to it. But the biggest thing for me, if you don't have a plan to get out, then how are you ever going to decide? Now you're going to decide as you're panicking, where if you decide ahead of time with a calm mind and say, I can handle $1,000 loss on this, but I don't want to lose any more than that. Well, once you get to your $1,000 loss, you made this commitment, stick with it.
Martin, where can people follow you and find out more about trend news?
Well, you can go to the trendletter.com. I post market notes on the site, and today's notes I'll throw in some links at the bottom of the notes. You'll see a table with offering all kinds of little discounts, various combinations. You can get up to about 65% off. Also, listeners can sign up for our free headline service, and what we do there is every morning we look through the market and we pick out headlines that we feel investors need to be aware of. And then each headline has a link to the actual story if you want to read about it. And, if you sign up for this free service, and it is free, you won't get any spam. We don't like spam. We just don't do it. And I know so many services do. You don't have to worry about that with us. If any of your listeners have any questions about our service, you can email us at the info@thetrendletter.com. And again, for your listeners, come visit us at the World Outlet Conference booth, February 3rd and 4th.
Martin, thank you so much for being on This Week in Money.
You're welcome, Jim, and thanks for having us.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. He was speaking to us from Coquitlam, BC, which is just east of Vancouver. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Martin Straith, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@howstreet.com. Now stand by for a company showcase update from RecycLiCo CEO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija. He's the CEO of RecycLiCo. Zarko, welcome back to Company Showcase.
Thanks for having me, Jim.
Zarko, there's a lot of news out there, so maybe just start it off for us.
Yeah, no, I gotta say it's been a really exciting start of the year. First I'll just go in order of the news releases we've had so far in January. But the memorandum of understanding we signed with Sonid is really a great first step in outlining a business framework for strategic partnerships where really both companies can formalize commercial plans for battery recycling. And we see an opportunity there. We are excited about the opportunity that this represents, and we're going to continue working hard. Not just there, but continue expanding our reach in multiple regions. Looking at different MOUs, partnerships, and we believe this year is a year where we're scale up ready and on the cusp of multiple strategic partnerships. And Sonid being in South Korea, I gotta say, the lithium-ion battery market in Korea is mature and really well established. And, they have a strong focus on innovation and research and development. This also makes it a really competitive, highly competitive market, but also one that is open to new and innovative technologies. And, we are also seeing a lot of expansion from these Korean firms in the North American and European market. But RecycLiCo has the potential to be highly impactful in this market, but also the global market, given that, we have received in our second press release that we had out, we did receive positive report for our cathode precursor material from a Korean cathode manufacturer. And this is even when in comparison to commercial precursor materials and other recycled materials, which is a significant achievement for RecycLiCo. The potential for future commercialization of RecycLiCo's technology is promising with the increasing public validation of our cathode precursor material from the recycled and upcycled battery waste. And this means that it could be a viable alternative to commercial precursor material and could be used in the production of lithium-ion batteries, which aligns with, you'll see a lot of regulations being put in place in terms of a minimum recycled content in new lithium-ion batteries. And I think those minimums are also just going to keep increasing as well. So you're going to need to have more and more recycled content in new lithium-ion battery cells. And I know I've talked a lot about the cathode precursor, but let's not, forget about the lithium, which is in all lithium-ion batteries. And, I always say it's called a lithium-ion battery, but lithium is not as efficiently recovered as one would think by conventional recycling processes, especially to the purities that we are able to achieve. And, this week we did announce that the delivery of battery-grade lithium carbonate and lithium hydroxide to battery manufacturers in Korea and Japan. So just a reminder, we do have options in the flow sheet for production of both. And this is different from, the companies that we have sent these materials from. This is different from the company that analyzed our cathode precursor. And I know there's been a lot of questions about this, but given the number of NDAs we have signed and the competitive nature in this space, it should be very clear why we cannot mention names at this time. But overall, being able to produce battery-grade lithium from waste batteries is a significant step towards a more sustainable and circular economy for the lithium-ion battery industry. And really the way I see the next steps for RecycLiCo will involve continuing to work with all these parties to explore potential business partnership opportunities. Because the way, from their perspective and the way we see it as well is that, we have a bespoke, asset-light, and capital-light business model that is attractive for many companies in the industry that see the importance of battery recycling and an opportunity to expand their business potential and business models. Additionally, our business model of joint developing the technology with potential cathode and battery manufacturing partners enables them to directly reintegrate their battery waste into recycled battery-ready materials while gaining economic and environmental benefits. So, it's I want to just say keep the momentum going this year. I think we're off to a great start, and like I said, I'm really excited for what this year is going to be all about.
Zarko, one of the negative comments about electric vehicles is there's no practical solution to battery recycling. Isn't that what your company's all about?
Yeah, I think, there's a lot of people are starting to get educated on the fact that recycling is possible. There's always the common narrative about batteries going into landfill waste, but I think when it comes to the size of an electric vehicle, a battery pack, I just don't see the possibility of that, right? Somebody will want that battery pack, but it's important to do it the most efficient way and to get all those materials out, right? We're not just targeting specifically nickel or cobalt, but, like I was mentioning, even on the lithium extraction side, it's important to get maximum recovery of all those valuable materials.
Zarko, for people who are new to RecycLiCo, what does the company do?
RecycLiCo is a battery materials company focused on the recycling and upcycling of lithium-ion battery waste. And so what we mean by, recycling is one thing, but upcycling into battery-ready materials. So making sure that these materials are to a quality that can be used again in new lithium-ion battery materials and promote a circular economy.
Zarko, where are you traded and where can people get more information about the company?
Yeah, we're traded on the TSX.V under the ticker symbol AMY. We're on the OTCQB under AMY.V and the Frankfurt Stock Exchange under ID4. And you can get more information on us at our website, www.recyclico.com.
Zarko, thank you so much for the update.
Thanks, Jim.
My guest has been Zarko Meseldzija. He's the Chief Executive Officer of RecycLiCo. I'm Jim Goddard. Our conversation took place on January 20th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.